The next thing before you start learning how to trade is have a morning routine. If you don't have a morning routine when you're starting to trade, your mindset's going to be all over the place. You're not going to have set goals. You're not going to follow your rules correctly throughout the day. So get out a piece of paper, put it on your wall, get a whiteboard. Who cares? Write down things you want to accomplish for the day and how you're going to start your pre-game, before you start trading. So for me, I wake up 6 a.m. The market opens 6:30. I walk outside for a little bit in my backyard or front yard, get a little bit air inside my lungs, right? And then I grab a water cup like this, fill it all the way. I chug the whole thing, cold water. That wakes you up inside. Now, once you drink that cup of water, you have all that energy in your system. Stretch a little bit, go wash your face with water, brush your teeth, do everything you need to do. Sit down, write down your rules for the day you're going to stick to. Oh, I'm only going to stick to my order blocks. I'm only going to stick to the fair value gaps. I'm only going to take this strategy on this PA, on this account. I'm going to have only $200 stop loss today, $300 stop loss. I'm not going to trade more than 2 times per day, 3 times per day. Whatever your rules are, write them down, put a sticky note on the middle of your screen. And every time you press that buy or sell button, look back at that sticky note, make sure you're following your rules. This is the most important part. You have to have a daily routine before you start trading and during your trades. Without this, you're not going to get successful. You're not going to reach anywhere. And this is what builds consistency. You have to start this small little thing, waking up, drinking a cup of water, going for a walk, getting air inside your lungs before you sit in your room all day and trade. Because sitting in the room all day and trading, like, come on, I'll admit, it's kind of boring. So just get your morning routine done, get that energy. If you want, halfway through your trading day, drink a cup of coffee. I take these caffeine pills a little bit, okay? It's 200 milligrams of caffeine, nothing crazy. But that thing just boosts my energy and gets me in the mindset of trading. Clears my focus and puts me in the right mindset. So before you even think about touching that buy or sell button, remember, am I going to stick to my rules? Am I going to follow the strategy? Am I ready to trade? Am I emotionally ready? Because if you're not emotionally ready to trade, you're not going to get anywhere. Let's say you're having issues with the family. You're having issues with the relationship. You're just not doing good for the day. Pause, take a break, go think about all the things you're grateful for example, right? Just thinking about all the things you're grateful for will put you in a good mood. So by you being in a good mood will result in you taking quality trades. If you're in a bad mood, you're not going to take quality trades. You're going to get emotional. You're going to revenge trade and no one wants to be there. All right, the biggest thing that I'm going to teach you here is forget everything you know. Forget all the trend lines. Forget all the EMA crossovers. If you used indicators, stop using them. RSI, MACD, divergence, whatever it is, Bollinger Bands. Forget all of that. You don't need any of that. You want a clear chart, nothing else on your chart. Literally just candles in your eyes. If if order block forms, draw it on the chart. If a fair value gap forms, draw it on the chart. If you have key levels, draw it on the chart. Do not draw arbitrary lines on the chart. Don't draw like triangles, none of that, because it's all pointless and useless. That's not going to make you profitable. It's not going to teach you how to trade. Why should you stop using those indicators? Number one, they're lagging indicators. RSI, MACD, they're all lagging indicators. So by the time you're in the trade, it's too late. The data is not completely accurate. Now, people can make them work. The likelihood is very, very low. Like, realistically, trading price action is way better strategy overall. Now, why am I so against trend lines? Now, if we go to the 1 minute chart, right? Millions and millions of patterns. So someone wakes up one day, goes to the chart. They're gonna look at the chart, be like, "Oh my God, it's a wedge, it's a triangle, right?" But this wedge or triangle, breakout, whatever the fuck you're doing, it's not gonna work always, and it's not gonna work. This is arbitrary as hell. It's the same as looking at clouds. Now, if you look at the cloud, you're gonna see like whatever your imagination tells you. If your friend looks at the same cloud, he's going to see something completely different. If you're on a different time frame, it's the 5 minute time frame is going to tell you to go long. 1 minute is going to tell you to go short. It's completely random. You can't draw arbitrary lines on a chart and base your analysis off of that. If anyone does that, automatically just stop listening to them, because that's just clown behavior. Now, channels. Yes, the market does move up and down in channels, but you can't base your trades off of that 1, 2, 3 touch. And same with double top, double bottom, any of that random shit that beginners learn. All that is fluff to stop you from becoming successful. That's just information that beginner YouTubers teach you because you're going to believe it. You're going to start training them, you're going to start failing, and you're going to buy their course. That's just how it works. I'm here to teach you actually how to properly trade with market structure and price action. So watch the videos, learn how to trade properly, and enjoy and take notes. Stick to one market. What do I mean by this? If you're trading ES, stick to ES for as long as possible. Let your learning progress develop. Let your strategy develop on ES. If you're trading NQ, same thing. You don't want to hop around markets and learn something new every single time you hop around. I've been trading SPY for 4 years. I'm going to stick to SPY, which is the equivalent to ES. So why would I start learning NQ when I've already mastered SPY? It makes no sense. A lot of people try to master it all. They try to be good at NQ, SPY, gold, everything at once. That is the worst thing you could do. All that's doing is delaying your progress as a trader, delaying your profitability, and your chance to become successful. Just focus at one thing, master it, absorb it, and then you'll be fine. Each market doesn't move the same way. They all move differently. When I look at the 5-minute chart on SPY or ES, I understand how it moves. I've been looking at it for years, so when I see a movement, when I see a pattern happening that I've seen multiple times, I'm gonna be familiar with it, and that'll determine if I'm gonna take it or not. It's just market experience. And you don't want to ruin that market experience by trading multiple markets. It's not healthy, it's not good, and all it does is delay your progress. I only recommend switching to a different market if that specific market has not been working for you for a long extended period of time, anywhere from like 3 to 6 months. You have no luck, you're getting no wins off of it, then yes, maybe you could switch and then stick to that for another 3 to 6 months. And please don't jump from market to market just because you didn't do good for a week in it, okay? All right, so the charting platform I use is TradingView. You could use it for free to chart on SPY, but on ES you do have to pay like a monthly subscription. It's pretty cheap to get the CME data. I personally trade only during New York session, so I have this indicator. So it's called CM underscore time-based lines. Zoom it in for y'all real quick. This is what it is, okay? So if you want, search this in the tab for indicators. These are my settings. I have that on there because that shows the first candle open of the day. Put 8:30 to 8:35. It does show the first 5 minutes of every single day, so you could see and separate the days. All right, let's get on to how to chart. First, we can go right here, all the way down, horizontal ray. I use this a lot. So you just put a line and it stretches it to the right infinitely, okay? Now, the way to put it and lock on a candle, you want to hold down control. Hold down control on your keyboard while moving it. It locks onto the wick or the bodies of the candles. As you can see, it just locks on and you can move it. So let's say you want to mark the high of day here. Boom. High day is marked on this. Let's say you want to mark the low day is marked down here. Just hold control. That's it. Now, the thing you want to do is when you're on here, favorite it. So it comes up in your favorites bar. These are my favorited bars. It's just a quick access tool that allows me to just quickly access anything I want. Next thing is down here, the GAN box. The GAN box I use time to time. It's just a one-to-one indicator for me. If you want to copy my settings, here are the settings. 0, 0.5, 1. You can change the colors around, doesn't matter. Time levels, you can have this on or off. It doesn't really matter. It just puts a line on the left right here. Yeah, so I basically use this like for my one-to-one entries, like the bullish candle, one-to-one. I close up here. Basically simple stuff like that. So the next section here, I don't use any of these Elliott wave, any of these patterns, triangle patterns, whatever these, I don't use any of those. Next section, I do use these. Long position, short position, I use these a lot actually when I'm trading. So again, hold control, click, boom, it sets the long and short position. If you want to know my settings, here are the settings I use. It's literally just basic settings. And when you move this up and down, up here it shows you how many points it's going up or down. So up here is 20 points until here it's 10 points. Now it shows you percent wise and tick wise and point wise as well as price wise. I only pay attention to point wise because I base all my trades off of points. All right, next section is the little brush right here. Arrow marker and rectangle are the main ones I use. Favorite these, put them in your favorite slots. Now this is my box tool. So for the box tool, the way I got it to look like this, the border is just transparent. I have no border. There's no line in the middle. Background is literally just orange. Change the color if you want, but I use yellow or orange. A lot of time I do have this extended to the right, but when I am trading fair value gaps, I don't have it extended all the way to the right. Now let's go over how to use all these together. So right here, we could get the rectangle tool and mark this little fair value gap right here. The fair value gap is just 3 candles, an imbalance between both of them, and the wicks have a gap in between. That's pretty much it. This bullish candle formed off of it, and I enter longs off of it. So up here, I'd enter longs using that long position tool. My stop loss would be a tick below. And profit, see, this is the risk reward ratio now, 1 to 1.5. Now, if you bring it up, that's now 1 to 2. So the bottom is 1, top is 2. See, the stop loss is 3.25, take profit is 6.5. That's how you use it. Now you just drag it all the way over and set your TP all the way up here. And if you don't know what price it is, if you want to see what price it is instantly, you get your horizontal ray tool that I mentioned earlier. Put it where that green line is, and you can see the price on the right side. 51.3975 is the price. If you want to see for stop loss, do the same thing, and boom, that's your trade. And you entered here. You can use the horizontal array to see what price your TP is at all times without putting your mouse here and looking right and looking at the price. And you can also use it to set levels as well. And you can do the same thing with right here, the horizontal line. This just does the same thing, but plots the line on both sides of the chart, infinitely left and infinitely right. And it's pretty easy. Move your mouse, move the chart. If your chart is stuck on the right side, just move this up and down and you'll be able to move the chart. If you want to zoom out by pointing at somewhere, hold control, point somewhere, zoom out, zoom in, point somewhere, zoom out, zoom in. So I go over here, zoom out, I zoom in over here. Pretty simple. And if you do want to add indicators up here, there's an indicators tab. You search up here and add any indicator you want. The only indicator you want to add is the one I literally just mentioned up here, right here, CM time-based vertical. Again, use this. It's very useful. And another indicator I use is Lux Algo's fair value gap indicator. Now, I hate indicators. If someone uses indicators, I automatically think they're a bot. They don't know anything. But this indicator does come in helpful when you just can't see the fair value gap form when you're first starting off. I'm not saying solely trade off of the indicator. All this does is show you fair value gaps and help you identify them. Like right here, you wouldn't trade off of this, you wouldn't trade off of this, but you would take the trade off of this, as I said. So you would take a long off of here. So you take a long off of here, like stop loss 1 tick below the candle, and take profit 2 to 1, take profit up there. Again, don't rely only on this indicator or any indicators. Study your strategy, stick to your rules, and you'll be good. What's a candlestick and how to identify and read them? So the way a candlestick works is very simple. It's the basic thing in trading, right? The green candles, how they work is the bottom of the candle. So right here. So each one of these lines is a candle. The bottom of the candle is where the price opened on this 5-minute chart. So this is the 5-minute chart. There's different types of charts, 1 hour, 1 minute, where each one of these singular candles represents that time. So we can go to the 1 hour, and each one of these bars represent 1 hour of price action. And the way we could determine where it opens and closes is based off of the color. So green candles open on the bottom and close on the top. So this is the 1 hour. So this is 9:30, for example. This is a 9:30 candle. Market opens 6:30 for me. This is the 6:30 to 7:30 candle. This is 7:30 to 8:30 candle, 8:30 to 9:30, and then 9:30 to 10:30. You get the point. So each one of these candles represents 1 hour of movement. The candle opens here, closes up here. What are these little lines right here? The wicks. These little lines right here are called wicks, okay? Now, wicks are really important. It shows what price action did in that time frame. So in this 1 hour candle, price opened up here. So price opened at the top of the red candle. The price dumped all the way down and retraced and closed here. That's why there's a wick. So when this candle closed in this 1 hour, market dumped, retraced back up, closed here. So that's why there's a wick. Same thing with this. This candle opened here, wicked down a little bit, pumped all the way up, retraced, closed right there. That's why there's a wick. A wick just shows price action in that 1 hour time frame. Body of the candle is where the candle opened and closed. So let's go back to the 5-minute chart. Same exact thing. Green candles open on the bottom, close on top. Red candles open on top, close on bottom. Right here you can see price opened right here. Pumped up, pumped up, came down, closed there. And then what? Next candle over. This 5-minute candle opened here. It pumped up to the top of the wick, came all the way down, pumped back up, and closed right there. So if we go back to the, let's say, 10-minute chart, and we mark these two candles right here, the top here to the bottom. I just marked the top of this 10-minute to the bottom of this 10-minute. Now if we go to the 5-minute, you could see this is what it looks like on the 5-minute. Completely different, because market opened here, pumped up, came down, wicked the bottom, came back up. Now on different charts, it's going to tell you practically the same thing. In my opinion, the 5-minute is the most reliable for day trading, in my opinion. People can use the 1 hour, 2 hour, 4 hour, which is very common for like swing trading or holding for hours on end. I don't do that. I just stick to scalping and quickly trading in and out. I do hold trades for an hour max. The 5-minute chart is my baby. I've been trading it for 4+ years. So I'm going to stick to it. It's what I know, it's what I learned. And if it ain't broke, don't fix it. When there's 2 back-to-back green candles in a row, all that means is the candle opened here, pumped all the way up, closed there. Well, pumped all the way up, retraced, closed there. Same thing with this. Pumped up, retraced back, and closed there. Identifying candlesticks is pretty easy. Now, the next step is what type of candles there are. So I call these indecisive candles. These are where the body is in the middle. So price opened right here, pumped all the way up, came down, closed in the middle. It's indecisive. It doesn't know if it wants to go up or down. It's confused. Now, what do I mean by confused? How can you tell if it's going to go up or down? Now, let's open this, for example. These are bullish candles. These bullish hammers are very good indicators that price is going to continue going up. Now, not every time you see this candle, it means it's going to go up. For example, right here, there is a bullish candle right here. There's a hammer, but that doesn't mean it's going to go up. It all matters on how you look at the market. Earlier, I showed you the fair value gap strategy, right? So we have a fair value gap here, for example. This is a random example, but look, bullish candle, right? The wick is longer than the body. That means this trade is bullish. So you want to enter longs and hold. Now it did go up, but it wouldn't have hit full TP because I aimed for 2-to-1. So it would have looked something like this. Or you could play key levels off of them, and I'll go over that pretty soon. The strategy I loved is bullish candles off of key levels. Now let's say this is the key level identified on ES, and this bullish candle formed. Now what I do a lot is 1-to-1. So stop loss 1 tick below, 1-to-1 take profit. It pumps up, it hits my take profit because of this hammer, this bullish hammer. Now there are bearish hammers. Bearish hammers are this exact shape but upside down. So it literally looks like this, but imagine this was red. Same thing, key level here, bearish candle, thumbs down. Now I just inverted my chart just to make it easier, but imagine that candle was red. It can be green as well, doesn't matter. A quick refresher. So bullish candles can be any color, green or red, okay? Green candles, open bottom, close on top. Red candles, open on top, close on bottom. Very easy to understand. Next thing is bearish candles. Same exact principle, but upside down. It's literally just upside down hammers. Now think of a hammer with the long handle, but upside down, that's a bearish candle. Now you could take these off of key levels or order blocks, and I'll go over that in the next sections. And indecisive candles, we already went over. It's when the body's in the middle of the wick. It's confused, doesn't know where it wants to go. You just don't touch those candles. Now, dead candles. Dead candles for my key level strategies, I don't like. I do like to have a wick so it indicates that it's going to go in a certain direction. For example, if it's a bullish candle, if it has no wick, I don't like it because look, this red candle, it opened on the top wick. It dumped all the way and retraced back, showing no signs that it wants to go back up besides this retracement. There's no wick on top, so it doesn't show me support that it wants to keep going, so I wouldn't take a long play off of this. So dead candles with my strategies are no-no. As you can see, I love it when they have wicks that shows major support, but the bottom wick for bullish candles has to be longer than the body. Remember that. The wick has to be longer than the body for it to count as a hammer. If it's not, then it's indecisive. That's a quick lesson on candles. Don't listen to these gurus. Do not listen to what people say about candle patterns. Candle patterns are bullshit. If somebody tells you 4 green candles in a row means it's gonna go up or down, 5 red candles back to back, oh, look at the 30-minute chart. If you see a certain pattern, that means history is gonna repeat itself and it's gonna continue. Oh, look at the daily chart. If it's a red, red, green, red pattern, that means do this. Bro, that's all bullshit. It's literally all bullshit. Stick to order blocks, fair value gaps, price action, and you'll be fine. Trust me. My Discord members alone have withdrawn over $60,000 just purely off of price action in the 5 months I've been teaching. So trust me when I say don't use triangles, don't use bullshit ass indicators, and don't use random patterns on the random time frames. I'm trying to save you time, bro. Please. Anyway, we're going to move on to key levels, how to identify them, and how to trade them properly. Fair value gaps. How can we identify fair value gaps? It's very simple. Remember these 3 things. 1 candle, 2 candle, 3 candle. It can only happen between 3 candles. Candle number 1, for example, if you find the fair value gap on a downtrend, the low of candle number 1 and the high of candle number 3. If there's any gap in between, that is your fair value gap. Now let's draw that real quick. So we get our box tool, the low of candle number 1 all the way to the high of candle number 3. That's our fair value gap. Right here, the low of candle number 1 all the way to the high of candle number 3. That's the next fair value gap. Let's continue going. Fair value gap right here. Candle 1, 2, 3. Candle number 1's high. Candle number 3's low. There's a gap in between. There's a space in between. That's a gap. Right here, you can see there's no fair value gaps right here. There's too much consolidation. The low here is literally at the next candle right here. There's no gap. Right here, there is a gap. 1, 2, 3. Boom, boom. There is a gap. Now let's continue going. Another fair value gap right here. Another one right here. Another one right here. You get the point. They're everywhere. Now let's show you a trade I took today off of a fair value gap. Let's go all the way over here today morning. So this morning opened up and dumped. We formed a fair value gap here. Nothing really happened for me to be interested in taking a trade. And then another one formed right below that fair value gap. The high of number 1, the low of number 3. There's a gap in between. We extended right, and you can see here a bullish candle formed off of it. I just went over what candles were. So this is a bullish candle. Remember, red candle closed on the bottom. I have a 2-tick stop loss on this trade, and my RR is 2. So 1 to 2 right here you can see. So you're risking 1 to get 2. I entered longs right when this candle closed, held, boom, pumped up, hit TP, and I was out. You could also trade fair value gaps like this, where there's a space right here, 1, 2, 3. Remember, the high of number 1, the low of number 3, and this candle closed below it. So this would be a short play, where you take a short off of this, 1 to 2 to 1 ratio again. And for this trade specifically, it didn't hit TP. It would have stopped the R right here. And I'm not here to teach you exactly how I trade or my exact strategy on fair value gaps or key levels. I'm just here to teach you the basics on how to identify them. Now moving on to order blocks. What is a key level? Let's chart it out right here. Let's get our horizontal line tool, drop it down right there. Key levels are levels on the chart that has multiple touch points, okay? We just move it right here, multiple touch points. Looks like there's multiple touch points right here. Low of day bounce here. It bounced right there. Bounced here, consolidated, went down, pumped up, bounced again. It's just prices on the chart that the market respects very nicely. Personally, I don't like plotting my key levels on ES specifically. I like to use SPY mainly. As you can see, respected these prices pretty nicely. Low day bounce here, pumped up, rejected a little bit right there, pump back up, rejected this again, pump back up. Now let's look at all my key levels I have. So these are all the key levels I've charted throughout the years, right? When price is all the way up here, it's pretty hard to spot key levels because there's not that much price movement. There's not that much price history to base your trades off of. Let's go back to when it was consolidating a little bit more. So let's go right here and zoom in. As you can see, the price follows these levels perfectly. All these levels are perfectly put. The way to trade key levels isn't to short every level or go long off of every level. For example, my strategy is bullish and bearish candles off of key levels. All the videos are on YouTube. So bullish candle off of the key level, you go long. Bearish candle off the key level, you go short. Bearish candle off the key level, you go short. You don't blindly just take key levels. I used to back in the day, Like 2, 3 years ago, I would scalp these on the 1 minute chart. I would plot them on the 5 minute, scalp them on the 1 minute. It was a headache, but I did it. Right here, you can see low of day bounce, consolidated around this level, pumped up, rejected, consolidated, pumped up, rejected. And as you just keep looking at it, you see how well the price just forms on these levels, on these prices. This channel right here got created in between two of my levels and then broke out of it, bounced off of two of my levels below, pumped back up and consolidated back in between my levels. Again, it's just areas that the market has touched a lot. Right here, touch point right here. Touch point on this, touch point here, touch point here. It's going to take a while for you to form all your key levels. Trust me when I tell you that. But just remember the simple thing. Key levels are just lines in the chart where the chart retraced a bunch of times in the past. If it's okay if it pumped up all the way through a level and all the way down through a level, that's completely fine. The key levels aren't rock solid and they're not always going to reject. You just have to realize when to play them and how to play them. As you can see right here, my key levels did play pretty nicely. This rejected here, rejected back up all the way, rejected here, pumped back up, consolidated, went down, rejected here. You get the point. But the only two things I would play here are these two bullish candles. Bullish candle off a key level, I'd go long. Bullish candle off a key level here, I'd go long as well. That's a quick summary how to chart key levels. Remember, it's just multiple touches on the chart. You could also form them off low and highs of days because low and highs of days are very good indicators of key levels as well as the previous closing price. Something very interesting with my levels is they always end up closing around my key levels. So the market always tries to close around one of my levels. As you can see, it always never closes in between. It always biases one of the levels. Like right here, closed. Right here, it closed at my level. Right here, it closed at my level. Closed at my level here. So you can use PCP, previous closing price, as your key levels, high and lows of days as levels as well. Order blocks. What are order blocks? Let's take a look right here at the charts. So I just picked a random day. Looks like we had a nice, what is this? Like a 16-point dump. This up here, this green candle is 100% an order block slash supply zone. What happens when we enter back into supply or the order block? We short this, right? We short this on the touch of the order block. Stop loss a little higher. Take profit can be 2 to 1 or it can be 1 to 1, whatever you want and whatever you've tested. Now, let's keep on identifying order blocks. Right here. This can count as an order block. But personally, I wouldn't like this as an order block just because of how hesitant the dump is, right? So this dump is only a 4-point dump. We want at least like 8-point dump to be classified as a proper supply demand zone or order block. Now, this wick right here gives a lot of hesitation, so I wouldn't consider this a nice order block play. Right here, for example, this is a massive pump of 12 points. This right here is 100% order block that formed. And if we're above it, that is a demand zone now. Same thing down here, a nice 8-point pump. This is now a order block, which is also another demand zone. Now let's look at this day right here. A massive dump here created a nice supply zone, which is my order block. Next time we enter the order block, I'm going to short. But what happened? We pumped up. We gapped above the order block. Now you can take a short off. Now you can enter longs off of it if it does dump back down. That'll just be an inverse order block. I don't take inverse order blocks. I just take regular order blocks. So if we have an order block below, I enter long. If we have an order block above, I enter shorts. So again, right here, another order block formed, pumped all the way up, a nice 12 points, and this counts as a nice demand zone slash order block for me. Now, it's very visual. You can obviously tell when order blocks form on the chart. Like, for example, right here, there is not any order blocks. There's no order blocks anywhere here. It's way too choppy for any order blocks to be formed. If anything, this can be a baby order block. It's a 7-point dump. This can be considered a baby supply zone slash order block, and it looks like it did work. Right here again, this is considered a supply zone slash order block. Drag it all the way to the right. You can see we started consolidating inside of it, dump down. Would have hit TP if you took the trade. Would have taken the trade off of there. Stop loss like right here where the candle is. Take profit 1 to 1. Smacked. Boom. Now, I'm not teaching you guys my exact strategy, as I already prefaced. Right here, I'm only going over general things on how to identify order blocks, fair value gaps, and key levels. Now let's move on to the next section, trade management.